Let's take our knowledge of ratios and work on an application of this and work together through this example. As I'm working through, please feel free to pause the video so that you can do your calculations without following along with me, and then check your answers to the video. We see here the ratios, various activity and profitability ratios for Walmart and Costco. Those should look familiar. And now we're adding in ratio values for Target as well. Let's go through each of these questions. Number one, which company uses the lowest percentage of equity to finance its assets? So now we don't have the financial statement data. We're just going based on these ratios. So we need to know which ratio tells us about percentage of equity compared to assets. That would be the equity multiplier. So this lowest percentage, we need to know to look for the equity multiplier. And then the next question is, here's our equity multiplier in this column here. Then we need to know to have the lowest percentage of equity. Do we want a high equity multiplier or do we want a low equity multiplier? Remember that equity multiplier has the average assets on top and average stockholders' equity on the bottom. So the lowest percentage of equity, we want a higher value of the equity multiplier. So the company with the highest value of the equity multiplier would be Target. And what we're saying here is that Target, of these three companies, Target uses the least amount of equity in order to finance its assets. Item 2, which company generated the most income from its assets? All right, if we're looking at income over assets, we are talking about return on assets. And which company had the highest return on assets here? This was Costco with 9.5%. Item 3, which company collects its receivables the fastest? So we want to look at a high receivables turnover, or we could look for the company with the lowest days in receivables. And we see that Costco and Target had the same amount of receivables turnover. We want higher values of receivables turnover and lower values of days in inventory. So it's a tie for Target and Costco. Next item, which company had the most profitable sales? So we know that this was profits are net income divided by sales. This is our net profit margin. Profit margin, 2.4% for Walmart, 2.6% for Costco, and 3.9% for Target. So of these three companies, Target had the highest or the most profitable sales. Which company sells its inventory the fastest? We're looking for the highest inventory turnover or the lowest days in inventory, and that would be Costco. And what's nice about this problem is that we're seeing a bit of a horse race here. Some companies, there's no clear winner so far, although we haven't seen Walmart do much. Which company had the highest return on its investment in stockholders' equity? Okay, so that's obviously going to refer to return on equity. And we see here Target had the highest return on equity of 34%. Which company generated the most sales revenue from its assets? All right, so which formula looks at the amount of sales that are generated from the company's average total assets? This would be asset turnover. Which company had the highest asset turnover? We see it's Costco, 3.64. Which company had the highest return on assets? That was, we saw that in item 2 where it didn't tell us exactly which which ratio we needed to look at. We had to decide. So that was Costco. And that leads us into the next item. Based on this information, the fact that Costco had the highest ROA, which driver or which of these two drivers helped the company obtain the highest ROA? So ROA is equal to the profit margin times the asset turnover. Okay, and profit margin, Costco, okay, so Costco had the second highest profit margin. So the profit margin is the second highest, so that's not what led to it. It must have been that it had such a high asset turnover. And we see asset turnover for Costco, 3.64 was so high that that more than offset the second being the second highest profit margin. Which company had the highest ROE? We said that that was Target with 34%. And then the next question is just asking us to explain that. Which of the drivers helped it to do this? Okay, so ROE is equal to the profit margin times asset turnover times the equity multiplier. And for Target, this meant 3.9% times 1.98 times an equity multiplier of 4.41. Let's look at that compared to Costco. We know that Walmart's not staying in this race, but Walmart's profit margin, Costco's profit margin is 2.6 and turnover 3.64. Let's compare this to Costco's profit margin of 2.6 times an asset turnover that was much higher, 3.64, but an equity multiplier that was significantly lower. Okay, so higher asset turnover but lower profitability of sales, lower or a greater use of equity. And so this meant that this worked out with Target having a significantly higher return on equity because of its higher profit margin and its higher equity multiplier compared to the profit margin, asset turnover, and equity multiplier, or ROE for Costco, which was 28%. Next question, this is taken directly from Becker CPA review material. The following data has been extracted from the financial statements of Hutton Inc. We have an income statement, and we're asked what is the company's net profit margin for year 2 and for year 1. Okay, so we know that our net profit margin is equal to net income divided by net sales, year 2. Easy problem as long as we've memorized this formula. 350,000 divided by 3 million, and 308 divided by 2.6 million. This works out to be 11.7% for year 2 and 11.85% in year 1. Okay, so this must be answer C. Next item says if Hutton, so we're still looking at this company, if Hutton sold $100 of inventory for $100 of cash on December 31st of year 2, which of the following ratios would decrease? Would it be net profit margin, return on equity? Net profit margin, we know net income over sales. Return on equity, we have net income over equity, but we don't have any information about the equity here. So, and then if net income would not change, if we sold inventory that cost us 100 for 100, net income doesn't change. So that wouldn't change equity either. Working capital turnover, this has to do with our current assets and our current liabilities and the relationship between the two of them. And cash and inventory are both stay the same. So nothing would happen to the working capital turnover. Return on assets, net income divided by assets. Net income wouldn't change because if we're selling the inventory for the same cost of the inventory, there's no change to income. Our assets wouldn't change. These would just be offset, giving up inventory, getting cash. And let's look at net profit margin. So our net income would not change, but our sales number would increase. So what would happen here if the numerator is unchanged and the denominator gets bigger? This would decrease the overall ratio. So it would have to be item A here. Net profit margin would decrease. And finally, the controller of Peabody has been asked to present an analysis of accounts receivable collections. The following information is used. What is the accounts receivable turnover ratio at the end of the most recent year? So we know what our accounts receivable turnover ratio is. We have to memorize that formula. Accounts receivable turnover. We have our sales, net sales divided by average accounts receivable. This is, of course, always net of the allowance of doubtful accounts. Sales were given 400,000. And then accounts receivable, the average accounts receivable ratio. Now, when we're looking at Becker, sometimes they want us to use the average and sometimes they just want us to use the ending balances. I would say here, because we're giving the beginning balances or the ending last year, we're going to need to calculate the average. If for some reason I don't get the answer, I'm going to try just using ending balances. This cost of goods sold, this is distractor information, so we don't need to use this at all. So if I'm going to take an average, I'm going to need to get my accounts receivable in the most recent year, 100,000 minus the 20,000. So I'm going to take off the thousands here. 80 plus 130 minus the 40. Of course, our allowance for doubtful accounts reduces the value of our accounts receivable. And so we have 80 here, 90 here, 170 divided by 2. $400 divided by 85. I get 4.7 as my accounts receivable turnover. So the company collects its receivables almost 5 times during the year. And then we see that part D is an answer choice, so I would choose that one.